Okay, we are live. Good morning, everyone. Welcome to Certed Pay's Coffee Break. This is week number 17, and we are very excited to have you with us. I am your host, Rachel Camella, and I'm here with our moderator, Cindy Merkel from our HR team. Today, we're going to talk about the hidden cost savings that you might be able to find. So again, Certed Pay is glad to have you with us this morning and every Thursday for Coffee Break. I'm drinking a delicious Americano from Temple Coffee in California. Thanks, Temple. I love your coffee. Cindy, what do you have?
My usual dark roast with 2 shots of espresso.
Come on, you got to change it up a little.
Nah, I'm good. I'm not that much of a creature of habit, but I like my coffee just like this.
I'm not necessarily a creature of habit, but I am a creature of coffee.
That you are.
Okay, so talking about some hidden cost savings, we thought this was an important time to bring this up because you may have some tax credits that you can find. You may have some additional things. You also may be in a little bit of trouble and need to find some extra savings or some extra dollars somewhere. So we thought this was a good time to cover these kinds of topics to get you guys in a good position for to prepare yourselves for the end of the third quarter and moving into the fourth quarter of the year. So some of the things that we're going to talk about today are the tax credits that you can get through the CARES Act. Yeah.
I'm having issues hearing you. Can somebody else chime in on the chat box and let me know if it's Rachel or if it's just me?
Let me mute some other people. Testing. How's my sound now?
It's obviously me. Go ahead.
Everybody says you can hear. Sound is great. All right, Cindy. Maybe it's you and your internet issues.
I might call back in, so just be prepared if I'm not.
Actually, your sound is breaking up a little bit for me. Let's just keep rolling and yeah. Let's keep rolling. Okay, so some of the things that we want to talk about today are going to be some tax credits through the CARES Act, the tax credits connected to the FFCRA, any paid leave that you guys may have paid out to people. We want to help you maximize those dollars. And then also we're going to talk about some hidden payroll savings, some things that you may be able to do to get some dollars back in your account or prevent them from leaving your account. And unemployment claims management, a good topic for right now, so something that we may be able to help you with. All right. So when we talk about the CARES Act, people automatically think of the PPP loan. So the CARES Act really has these 4 components. So assistance for workers and families. This was the boost to unemployment. The extra unemployment dollars that went in, that $600 a week boost, the extension, those pieces. Assistance for small businesses. This was the PPP loan and the EIDL loans. The assistance for state, local, and tribal governments, this was additional funding dollars that went straight into these bodies to help their government support their areas. And then preserving jobs. So preserving jobs, this is what we think of in terms of the ERTC loan, that employee retention credit, and the extra places, the tax deferral, and the places where the money went straight in to help your employees stay employed, to help you keep your employees. So that's going to be our focus here this morning for this piece. So when we specifically talk about that, we have that employee retention tax credit, the ERTC or the ERC, same thing. It's the employee retention credit. And so there's a couple of things. This is available for all employers. If you have 1 employee or however many employees, this is an available tax credit. There's a dividing line at the 100 mark. So any employer with employees over the 100 mark, this tax credit is very specific to pay for wages where the employee is not actually working. So you pay the employee the wage even though you were not open, you were forced to close, whatever it is, your employees did not work. And then this was available. So it can be applied to up to $10,000 in wages for a total of $5,000 in tax credits. So pause for a second and let me go to the under 100s. Under 100, it can be paid for anybody who lost business. So you were ordered to close, you were limited, your gross profits were down by 50%. And in this case, whether your employees are working or not, you can apply this credit, but it has to be a significant loss in revenue. And so same thing, up to $10,000 in wages for a total credit of $5,000 in tax credits. Now, in that total, the $10,000 in wage total, you can add in also the qualified health care expenses. So that credit, that $5,000 credit, can be not only wages, but also the employer's share of health care expenses that you paid. So that total bundle is $5,000. If you got the PPP loan, you cannot take the ERTC in any format at any time. Even if your PPP loan was, you finished your covered period, you got your loan forgiven, you still cannot use the employee retention credit later in the year. If you got the loan, you cannot do the ERTC. If you got the PPP loan, but then changed your mind and you said, we're not going to do the PPP, we're sending it back. You sent back all of the funds, then that is perceived as not receiving the loan, and therefore you could use the ERTC. So that is a very clear line there. So be very careful and make sure that you have all the information up front. And add those extra expenses in. If you didn't pay enough in wages, see about adding in the healthcare expenses so you can maximize the amount of credit you're eligible for. The idea on the ERTC is that it can be done immediately. So you run the pay cycle, you can do the math. Look, how much of this can I get credited, and immediately take that credit. If you have a payroll processing company, like CertaPay, we do it as quickly as we can. Talk to your payroll provider. Make sure if you are doing this credit, get the credit right away. And if you don't take it right away, that's okay too. You can do this. You can process this on your 941. In addition, you may also have credits that total more than what you owe, and you can do the 7200 form and get that credit right away. So there are things you can do to help you with that difference and get you that extra boost or the credits right away. So look into that, call us, call your payroll provider, take a close look at that, and take those credits as soon as possible. Now we also have the tax deferral. So this is for the Social Security portion of taxes due. You can push those taxes due all the way to the end of 2021 and 2022. So throughout the year, any Social Security taxes due, you can push that. Half of it will be due at the end of 2021 and the other half at 2022. Now, having said that, you have to be very careful about double dipping. And this is one of the things that we have heard throughout IRS, Treasury Department, DOL. Everybody has the same comments. Be very careful. It's really the thing that they're looking for, and they want to remind everybody, be very careful not to double dip. So if you have, and we'll talk about the FFCRA in just a minute, but if you have wages that you're getting tax credits on, only use it one time. So whatever wages you're getting credits on, only use them for that credit. Now you can do multiple credits, but only on one portion of wages. So we'll explain more about that in a minute. How are we doing? All right, I think we're good. And we may have lost Cindy. Let's see. We'll just keep going. Okay, So FFCRA, again, we've talked about this quite a few times. Just a quick overview. This applies to all employers under 500. And, whoops. And to get the 80 hours of sick pay, there is no limit in length of service for that employee. But as soon as they cross over to the emergency FMLA expansion, there's a 30-day minimum. And then the first 80 hours for paid leave or caring for somebody else, remember it's an average. So it's an average number of hours, average of wages. And so the average hours, if somebody normally works 30 hours a week for you, then under FFCRA, they're eligible for 2 weeks of pay at that average. So they would get 30 hours in the first week, 30 hours in the second week. Also, wages are average. You want to do a 6-month look back if you can and get an average hourly number, and that's the number you use to pay those wages. The additional 10 weeks is specific to childcare as a result of COVID-19. So providing if you have to stay home with a child who's home from school or their healthcare provider is no longer available, whatever it is, that's the expansion piece. And that can be used intermittently, again, based on average hours and average pay. We have quite a few FFCRA webinars and coffee breaks available. So if you need more information about that, you can find those on our website and get some more detailed information. You can also reach out to us anytime and we'll help you with that. So under FFCRA, full pay is capped at $511 a day and 2/3 pay is capped at $200 a day. Now, having said that, those are the caps for the wages, but when you take your tax credits, you can also add in the healthcare expenses and the employer's share of Medicare tax. So those extra pieces are eligible for credit as well. Don't miss out on those dollars. So the payroll tax credit applies to the emergency sick pay and that expansion in FMLA. And you can get that refund for wages paid if you exceed. So if you get more, if you have more credit due than what you've paid in, and when you're taking that credit, you're looking at all employees' taxes paid in, not just the people who are using the FFCRA. And then you take that credit against that. If you are still going to be due more tax dollars in credit, then do that 7200 form and get the extra dollars back. And don't forget to add in the extra thing. Your wage dollars are capped, but you can add those extra, the healthcare expenses and the employer's share of Medicare tax above and beyond those daily totals. So don't be afraid to add those in and maximize that. The daily total is capped at $511. That was the number. It hasn't changed. So it's $511 per day. It's $200 a day for the 2/3. The $511 is the full pay cap. I saw that question come in, so just checking it there. Okay. All right, guys, let's keep going. So in addition to those savings, those tax credit savings, I wanted to bring up some other points, some things that you might take into consideration. These may not apply to everyone. Maybe only one of these applies to you, maybe all of them apply to you, but be aware of them. So it might be a good time to look at restructuring your team. Do you need to change around some of the job duties and job descriptions? Do you have specific tasks that it makes more sense to shift around? This is a great place to look at, you know, with people who may not have returned as a result of COVID. Maybe you don't have to fill that position, but maybe you can restructure and save some of those payroll dollars. So take a close look at that. And I put outsourcing in here because when you're looking at restructuring, it's a great time to get help with that. And if you don't, especially when it comes to HR, if you're not outsourcing your HR, right now would be an important time to do that. The terrain is changing, the terrain is rough. And if you don't have expert eyes on that, it may cost you money, or prevent you from saving money that you could save. So pay attention to those things. And same thing with payroll. This might be a really important time to outsource your payroll because payroll providers know where the savings are. And so, of course, I want you to use Certipay's payroll process, but take a look at outsourcing these functions right now because this is where you might save a bunch of money. I wanted to bring up the WOTC program, Work Opportunity Tax Credits. These are another great place to save money. Now, if you don't have this program in place, you have to do your homework, do some checking on this. And if you aren't going to be able to do tax credits retro for anyone. You can only apply WOTC tax credit going forward on new hires, and you can't even use it on a returning employee. So this would be a credit you may be able to get going forward for hiring somebody who otherwise might be difficult to employ. And that's kind of the concept behind the Work Opportunity Tax Credit. But they're big credits. So if you have positions, you know, when you look at that restructure and you have positions that might make sense, if you have your WOTC program intact, you can save even up to 40% of an employee's wages in tax credits. So look into this program. There are also services out there that manage the WOTC program for you. It's a little bit paperwork intensive, but if you get help with that, it really can be cost effective. It can be a great platform to save some tax dollars to the tune of thousands of dollars. So don't be afraid to look into that and add that program in. Finally, direct deposits. If you are, this is an easy one. If you have a policy for your company where all payroll goes direct deposit, you save on, right off the bat, you save on delivery fees, check printing fees, and then you have soft dollar savings because your employees are not trying to get to the bank, or they're not trying to take an extra amount of time at lunch break, or they're not worried about getting that into the bank. It all around saves you money and time. And if you've got an employee who doesn't have a bank account or has a problem with that, pay cards are a great option. And little to no fees for the employees and employers on pay cards. So something to look into just by making sure all of your payroll goes direct deposit will save you money. And depending on where you are, even if you just have a few people left that don't have direct deposit, I would push everybody to get on a direct deposit right away. This will save you money every pay cycle. Are we good? Everybody still moving? Yeah, I saw you pop back in. Okay, finally, I wanted to talk about unemployment claims management because unemployment claims are obviously through the roof. We have so many people who are out, returning, out again. The claims management piece is not very expensive if it's something that you can add in or get some help with the claims management. And the return on this is tremendous because when you have claims management help, the claims administration goes toward reviewing and handling claims, tracking terminations and termination paperwork. It's a complete response. So you pass that on to an unemployment claims manager and they will handle everything for you. They sit in on the phone hearings. They do the pre-screening conference information they gather. They do the communication. They file appeals. They contest claims. This piece of work is tremendous. And the importance of doing this work now will show up during each year's renewal on your unemployment claims percentage rate. So if you keep your claims down and you have help managing those claims, it will save every year. It will help you with those dollars. It prevents you from spending dollars down the road, and it keeps the dollars in your pocket. Not only that, again, we talk about the soft dollar savings, it's the time it takes to do this. So having somebody else manage these claims for you pays for itself many times over very quickly. Also, when you have claims management, they will typically audit your process, they will audit your reporting, they will analyze the information, and then help train managers who are involved in the termination process. And they will provide information that helps that termination process run smoothly. And oftentimes they will even help with the termination process itself. So depending on the level of support you have, this is something that if you don't already have this, you know, from an HR point of view, we support this kind of claims management because we know how valuable it is and how much it will save you and help you.
Also, if I could add to that, there is, dealing with the unemployment, it's very difficult to win hearings if you haven't already figured that out and had to do it in the past. And a claims management person would be able to not only get through that quicker, the hearing quicker, but they would also know the ins and outs of the system to better maneuver through to win the hearing.
That's right. It's such a great point. You know, again, on the HR team, we fully support having claims management help because we know how time consuming it is. We know the work involved, and we know the impact and the significant savings available there. So some final thoughts before we go to questions. Look for these extra tax credits that apply to you. Don't miss out on the additional dollars when you talk about the employer's share of Medicare or adding health wages in. Pay attention to all those pieces. Be careful not to double dip. This is the biggest thing. It's important to really separate that out. And this would go to when you have somebody who's out on FFCRA and other tax credits, only use one block of wages for the credit you're taking. You can do multiple things in a pay cycle, but you have to be careful to carve them out and separate them out. Be creative. Maximize your savings, maximize your dollars. If it means changing around your structure, adding some consulting levels where it makes sense, getting some claims management help, whatever it is, be creative because the dollars will come back to you that way. All right. Any questions this morning?
I do have one, Rachel. I believe you answered the first couple due to my technical difficulties. The question is this: as a CertiPay user, what is the best report to use to reconcile the ERTC calculation?
Okay, so going back to that, you want to remember the 100 threshold. And so if you're an employer who's under 100, then you can use any of the wage reports we have that show total wages. And so knowing that you can claim the tax credit up to $5,000 worth of tax credits. So contact your payroll specialist and find out exactly how that can be applied. I know that sort of didn't answer it, but wage reports can help you. We don't have a specific report labeled ERTC because everyone is a little bit different, but you can take a look at your wage report and see how many wages were paid for each individual, carve out anybody who may have been out on FFCRA, and then apply it to those individuals. And we have people in the payroll department who can help you with that. Some of them may be on this call.
This is another question. It says, just confirming, we have had a PPP loan, and that means we cannot get the ERTC at all, even later in the year?
Yes, that is correct.
They run out but how about if they run out of their PPP loan dollars? Once those are over and they continue moving forward, can they pick it up from there?
No, they cannot. If you got the PPP loan, you cannot take the employee retention credit at all.
That was the only other question I had. Folks, you have any other questions?
I don't see any others. All right, guys. Once again, thank you so much for joining these coffee breaks. We're thankful to have you with us on Thursday mornings and sharing your Thursday coffee break with us. And CertiPay appreciates you and appreciates your business. So if you have any additional questions or need help, reach out to us anytime. Thank you so much.